SoFi stock is currently the cheapest it's been since it went public, and in this video I'm going to deep dive the company to see if it's worth investing in. SoFi is a company that has grown from a small fintech startup to one of the biggest competitors in the finance space, with the potential to disrupt a multi-trillion-dollar industry. And in their most recent earnings announcement, they've shown they are growing revenue 74% per year, nearly doubling their size. Hey everyone, and welcome to Fintech. In this video, I'm going to be talking about SoFi's background as a company, how they got to where they are today, and go over their most recent earnings report. Finally, I'll talk about why the stock is down to its lowest point in a year, and what the future of the company may hold for the stock price. So hit the like button if you want, and let's start by diving into SoFi's background as a company. SoFi was founded in 2011 by 4 co-founders, including Mike Cagney, the then CEO of the company. Cagney was a former trader for Wells Fargo and had founded his own hedge fund prior to meeting his future co-founders at Stanford Business School. It was at Stanford that they decided to start their own company. SoFi started out purely as a student loan company, offering loans to graduate students across the US. But they soon branched out into all aspects of personal finance, from offering home mortgages to a credit card, to more recently their SoFi Invest app, a stock and crypto investing app. They even recently became one of the first fintech companies to gain conditional approval for a banking license. But this growth, from a smaller student loan company to a fintech company large enough to challenge traditional banks, did not happen overnight, nor was it all smooth sailing. Early on, SoFi was plagued by accusations around a toxic work environment, and all of the co-founders except for the CEO left over the years to start different ventures. All this while SoFi continued to grow. The cultural issues ultimately came to a head in 2017 when the CEO left the company amid accusations of harassment from female employees. He was then replaced by the current CEO, Anthony Noto, who was the former chief operating officer of Twitter and who had experience as a managing director at Goldman Sachs and the CFO of the NFL. Since then, Noto has led the company into expanding into new areas such as crypto investing, and more recently building functionality to allow normal retail investors like you and me to invest in companies pre-IPO, something that has traditionally been restricted only to institutional investors. Today, SoFi has 3 main businesses: lending, technology platform, and financial services. Lending includes what you might expect: student loans, home mortgages, personal loans, and it's also their most profitable area. Their technology platform is built on the Galileo technology platform that they acquired back in 2020 for $1.2 billion, and that includes things like financial services APIs and a payments platform. Lastly, their financial services is probably the area that gets the most press. It includes SoFi Money, their bank account, SoFi Invest, their investing app, and the SoFi credit card, as well as several other products. Today, they use the approach of using their financial services products like SoFi Money and SoFi Invest to attract new users to their ecosystem at a very low cost to themselves. Once that customer is using a SoFi product, they then focus on upselling that customer to more and more products in more and more profitable areas of the company, like lending. This is one of the ways that the company has managed to grow so crazily fast over the last several years. But just how rapid has their growth been? Well, to answer that, let's take a look at their latest earnings from Q2 2021. So right off the bat, SoFi grew their revenue 74% year over year in their latest quarter. That puts them at $237 million in net revenue this quarter across all their different products, and beats their own estimate of their year-over-year growth by 9%. It also puts their revenue over the past 12 months at $852 million, up 35% from 2020. That's obviously not as high as their current quarter, but it also includes 2 one-time expenses totaling $33 million. If we were to take those out, they would actually be up $885 million. Which the CFO pointed out is up 89% compared to 2019, which is the last comparison that we have before lockdowns. And by the way, for this video, I read through SoFi's entire earnings call transcript for Q2 2021, and it was not short. So if you appreciate that kind of effort, please just hit the like button and let's continue. Their adjusted EBITDA hit $11 million this quarter, which is up $35 million year over year, and exceeded the midpoint of their guidance by $14 million. In terms of their products, they saw a 1.7 times increase in the total number of products that were cross-bought in the quarter versus in Q2 2020, meaning that more customers are moving from one SoFi product into several others, which is key to SoFi's entire growth plan. They also noted on the lending front that they have made some big improvements with automating the lending process, with more than 50% of their personal loans being processed entirely using automation. This is the direction we want to see from SoFi, but they do still lag behind the more focused Upstart in terms of their overall automation. Lending overall grew 47% to $172 million in adjusted net revenue. So this is really the meat of where their revenue came from. And a big chunk of that growth came from personal loans, a market that should grow in the future. Their tech platform, so mostly Galileo, had a net revenue of $45 million, which was driven by 119% year-on-year Galileo account growth. The tech platform as a whole was also profitable at a 29% margin. Now, this is lower than what is expected long-term, as they are currently making some big investments in moving their technology from an on-premise configuration and into the cloud. Now, ideally, I'd like to see SoFi already 100% in the cloud so that they could scale their growth faster, but since they're not, this is a good place for them to be investing their money. Finally, their financial services made up a small portion of their overall revenue, just $17 million, but that is up 7x versus the prior year quarter and up 2.6 times in just the past 3 months. That growth is driven by exponential growth in products, with every one of their products growing by over triple digits year over year. At the same time, not everything is rosy. They're only investing 70% of their profits back into the business, which to me signals that they are not fully confident in their ability to deploy capital back into making the business grow as fast as possible. Now, that's not a deal breaker, but it is a red flag. Additionally, they kept calling out on the call how they had hit an inflection point in their financial services. Basically, they now have enough financial services members that they make up a larger top of their sales funnel that can be used to funnel users down into the more profitable business segments like lending. This should be a really good sign that they're going to start showing improving growth in the future as their financial services start to actually move the needle in terms of overall growth. And yet, the stock price is down nearly 50% from its all-time high and over 20% since just before earnings. So let's now take a look at why the market may have reacted badly to this report and if that reaction is actually justified. So I think that there were 2 reasons for the recent price drop. Number 1 is just general SPAC weakness, and 2 is SoFi's earnings forecast for the rest of the year. So starting out with the first one, a SPAC or special purpose acquisition company is basically a way for investors to buy into a company before it goes public in an IPO. This is done by merging the non-public company with an already public blank check company, effectively making the private company public. Now, in the past, SPACs have generated some controversy, including those offered by Chamath Palihapitiya, one of the biggest proponents of the tool. Virgin Galactic, for example, tripled in value after Chamath took it public in an early SPAC. But Clover Health, a company Chamath also took public, later turned out had an undisclosed SEC investigation ongoing that caused the price to crash once the news was revealed. And that's not to mention Nikola, but it later turned out to be a mostly fraudulent company. But the thing is, how an already public company does today, months after it already went public, should be completely independent from the process used to take it public. Just because some people don't like the SPAC process, that shouldn't affect a company that's already gone through it. Yet, weirdly enough, we've seen a lot of companies that went public via a SPAC tend to trade up and down in correlation, and right now they're in a down cycle. Is this rational? Not as far as I can tell, but it is a noticeable effect hitting companies like Virgin Galactic, Tattooed Chef, and yes, SoFi. So that explains part of SoFi's drop. But I think the other factor affecting the stock price is leadership's forecasted earnings for the next few quarters. So they still expect decent growth next quarter at around $250 million in revenue. That would put them up around 5.5% quarter over quarter. They expect their EBITDA to drop slightly to negative $2 million at the midpoint. But for the full year of 2021, they expect their revenue to hit $980 million in revenue and $27 million in EBITDA, which would represent 38% growth year over year since 2020. So here's the problem. That's the same guidance that they issued last quarter before they beat expectations this month. So they're basically saying that even though we are 9% ahead of where we thought we would be at this time, we will fall back behind to our initial forecast in the coming months. While that obviously isn't good, they did offer some explanation for why this is true. First off, the CARES Act was extended through January 2022, which means people are less likely to need a private loan when they can use that program instead. Second, they will not receive an extra $12 million that they expected from an equity investment. for a total of $52 million in missing what they thought would happen, which basically wipes out any gains from having a good quarter this month. Now, as long as this truly is a one-time headwind that leadership had no ability to foresee, I would say that the company is still in a good spot, since they did grow more than expected, and that growth is just being temporarily offset by these one-time effects. But we're gonna have to watch that going forward to make sure those one-time hits don't become a regular excuse. So based on all of this, what do I think is next for the company? Well, I do expect SoFi to beat their forecast by at least a little, likely making it into the low 40% range in terms of growth year over year. I am also intrigued by their financial services hitting an inflection point, and we'll be watching that growth closely to see if it starts to move the needle and ramp up this company's growth even more. I also like SoFi's long-term vision. They don't see themselves as directly competing with other fintechs. In fact, they said on the call, our biggest competitive concern continues to focus on the 500 million accounts that are tied to legacy FDIC banks. We see that as the huge opportunity, and that's what we're going after. I think taking customers from traditional banks and slowly introducing them to more products is a winning strategy, and one that gives them a leg up even over other fintechs, simply because they can extract so much more value per customer with their massive suite of products. One interesting idea that was brought up during the analyst questions was the idea of SoFi rewards. So maybe you buy something with a credit card or you hit a savings goal, and in return you get credits to buy cryptos or maybe pay down a loan that you have. I can really see how as the ecosystem grows and it becomes better integrated, it could become almost like Apple's walled garden approach, where it's easier to just use other services within SoFi than going elsewhere. So what then did I do with the company's stock? Well, after making this video, I opened up a small position in SoFi just to keep it on my radar. This company has a lot of potential, and the whole SPAC drop really doesn't make sense to me. So I figure putting a little bit of money in won't hurt. However, I don't have the same confidence in this company as I do in my other large positions, but you can watch my portfolio review if you want to see those. But let me know if you invested in SoFi. Don't forget to like and subscribe, and I'll see you next time.